Hello. This is Troy White, Hoodoo Financial, and today I just wanted to check in with you and cover some finance and investing topics. I actually found some questions in my notes that I probably accumulated from who knows where, but I thought they'd be a good jumping off point today to discuss some finance and investment. First one: when should a person start using a financial planner? And that's a trick question because the answer is immediately, no matter what age you are, starting from a youth. Hopefully, your parents engage the services of a financial service provider and are saving and investing for their kids. But the financial planner title may change based on the level of assets that a person has. So, a wealth manager, investment advisor, portfolio manager, financial planner, banker, private banker, you know, down to mortgage broker or what have you. There are various professional titles, but it depends on the service that you need. But primarily, you need to learn, plan, and invest. So you need some level of financial literacy, and then you need some level of financial planning before and during the time you are investing. So you need all three. You need the ability to do all three. So, um, so with those titles, financial planner fits in there, but the answer is immediately. Uh, so, but I'll give you a more specific answer. Let's say from a practical standpoint, you'll really start needing to utilize a financial planner. Let's say when you're 25 years old, then you'll still be doing good. You'll be able to purchase investment properties, um, build a stock market portfolio. If you have entrepreneurial um, uh, aspirations, you'll be able to set that up over the long haul as well, all while you're still working on your career, because that'll be your training ground for whatever entrepreneurial endeavors you have in the future. So anyway, next step, the next bullet: steps to secure retirement through uncertain times. Steps to secure retirement through uncertain times. That's a difficult one because the word secure is difficult. When you say secure it, you're talking about an annuity. An annuity is an insurance product. So securing something implies you already have built that asset. So meaning you have a 401k that is substantial and you want to make sure you don't lose it during these uncertain times. So that the simple answer would be, or suggestion would be to take a look at annuities. Annuities are an insurance for insure your money. Make sure your money doesn't go down. It will go up at a certain rate and not below a certain amount. And there are certain stipulations as well. But that's the point blank answer. If you're the word securing your retirement, that's the answer. There's other methods, there's other techniques you could do depending on your risk tolerance. So what do you mean? What Because every solution is different for the individual because one person is is less risk averse than another. So one solution is going to be less good for this person than it is for that person. But fundamental answer to that is as some form of an annuity, which is insurance for your assets. It's a quick answer. Best way to diversify. Uh, Best way to diversify. That's another trick question because there is no best. What's good for you is not good for the next person. Um, what's best is a conversation with the client to understand um, their unique circumstance so that we can figure out what's best. But a simple answer to that is don't be a stock picker. At least invest in mutual funds and ETFs, whichever is your. If your preference is being a stock picker, then I'm going to say invest in ETFs instead of stocks. But build a portfolio of diversified assets. And so you need to take into account what you're doing at your job inside your 401k. Make sure that the things you're excited about investing in outside of your 401k aren't the same things you were excited about investing in inside your 401k. The types of investments that should go in your 401k are different. Those are long-term assets. It's a long-term play. Those are tax deferred assets. Similarly, what you invest depending on the account type. If you're in your Roth IRA, then I may say, oh, this stock is better than that stock for this account. This is possible. Uh, so there are a lot of factors that'll go into getting to this answer. Best way to invest to diversify. But at our firm, we're going to build a diversified portfolio specifically for you based on your risk tolerance. And we're going to do that with multiple portfolios to tackle your multiple goals. And so um, it's like having your own personal 401k. Instead of a mutual fund, it's a personal fund for you. And so we'll be diversified in that way. Each portfolio of stocks will hold up to 100 stocks, but each portfolio doesn't need to hold that many stocks. And as part of your portfolio, we can hold mutual funds and ETFs to either even further diversify your portfolio. So there's a lot of tools we use, primarily utilizing fractional shares, so it doesn't matter the investment amount. So I feel that is the best way to diversify your asset is opening an account with us and working with us in that way, but or somewhere similar that provides that kind of service. But if you don't have the time to work with a professional yourself, then just pick a mutual fund, an index fund, and that's roll with that. Russell 2000, that's 2000 stocks. Uh, the S&P 500, that's 500 stocks. The Dow was like 36 stocks or something like that. So if you get an index fund of those, you can't go wrong. That's the beta. That's the standard, market standard. So our next one, what is and how to start legacy investing? And I have in parentheses infinity banking. Now, this must have been through a conversation with my father-in-law. He was reading some things about infinity banking, and like whatever you call it, you want to call it these things, these special things. But what I call it, what I promote, is something different, not a specific product. It is an investment strategy and steps, process, and philosophy that can be summarized with legacy investing. Legacy investing is investing in such a way based on your financial planning needs and and to get you there requires you to become financially literate. So I'm speaking with and working with someone over the long term that will be increasing in their financial literacy and increasing in their business acumen and increasing their wealth. And I'm only a participant in that, and helper, and just helping to facilitate that. And we're utilizing your expertise and your creativity and your entrepreneurism to reach higher heights. But what do I mean specifically? You're gonna learn, you're gonna plan, you're gonna invest, and through legacy investing, we're gonna use that learn, plan, invest mentality and methodology to build an economic machine for your legacy that is passed down. We're not focusing on just fundamentally building up. This is the way that the world works right now. It's a no-win situation. The goal is to accumulate as much as you can inside your 401k, and then when you retire, you eat off that 401k until it's all gone, because you won't be able to make any more money at that point because your working life is over. And so that's the way they take care of the worker bees until you drop dead. But I have higher hopes for my clients, and I want to help you build that machine that continues to make money after you're gone. So for your legacy. And so that's after I'm gone as well. So maybe your kids will still work with my firm. Maybe my kids will run my son will run my firm and work with your children to continue that legacy. Maybe, or maybe not. But the point is, that's what we're trying to build. All right, that's the answer. What to do with my money right now? I keep hearing that a lot, and I'm hearing that because, oh, the market. I heard the market is crashing. What should I do with it right now? But then next week I get another call. Oh, I heard the market is hot. What should I do with my money right now? And so the answer is always going to be the same. For the individual, the strategy might find various adjustments, and the portfolios are going to be different. They are going to be structured slightly different based on your specific financial profile and your risk tolerance. But fundamentally, the time is right now. What was the question? What to do with my money right now? Right. So right now, the time is to we should identify what your portfolio should be, what the mix of assets should be for your portfolio, what you're trying to accomplish, what's the time horizon for your goals, and then we should build a portfolio according to that, and we should invest right now whatever lump sum that you have, and then we need to dollar cost average going forward. So that means you identify, say, I can invest $300 a month in my portfolio, and that's it. But I got this 3,000 right now that I can invest. So we need to properly implement in the portfolios that we identify for you going forward. Going to put that the 3,000 to work amongst those portfolios. Let's say the portfolios, to meet your goals, we're going to have 4 different portfolios. I'm just picking this. Doesn't matter what the goals is, but just in the time span of, down to retirement. So that includes 2 retirement accounts, a Roth and a traditional IRA, um, a non-retirement account, and a uniforms gift to minors account for your kid. So those are 4 accounts right there. So inside of those, we're going to have various portfolios because those are different needs in each account. So let's just say we tie 4 portfolios to those 4 accounts. I mean, one apiece to those accounts. So um, we're going to put that 3,000 divided amongst those accounts in some sort of form of fashion that that we discussed. And going forward, we're going to invest that $300 accordingly. Say 50 here, 50 there, 25 here. X amount there. And so we're going to do that from now until maturity of your uh, kids' uniform gifts, the custodial account, which would end at 18. But the others, we're going to keep going. This is it's an ongoing process. So that's what you would do right now. You would implement what you have and get on a path to a dollar cost averaging, because that's how you will take advantage of volatility. You won't be a crybaby and a worry wart over the market crashing, and you don't get overly excited when it goes up. In fact, I feel a little down and out when the market skyrockets. It's great for me, for the snapshot of my account, but I know that just means when I buy stock next month, the price is higher. I'd rather get it on a dip. So I like to hear when it goes down, and then I know that it's going up steadily because I don't hear any news. And so the market is, but I'm also paying attention to the market. But the market just goes on a steady, small climb, and you hear about the dips and you hear about the jumps, but you don't hear the day to day, just mundane climb that it does. So uh, that news doesn't start on me at all. So anyway, what to do with it right now? Implement what you have. Get on the dollar cost to averaging um, investment strategy according to your financial planning needs. Next question: pay down debt, invest, or save? That's always the difficult one, and you're going to read a lot. And I'm going to give you my answer. My answer is always invest right now. The part about pay down debt, all right, let's get save out of the way. There's a little bit that you need to save, but I don't, I mean, you just need to, we need to have a rainy day fund. But if there's some shorter term investment you need, yeah, you can call that saving. But your investment dollars is what I'm talking about. So we don't really save money, we invest money. So, but the pay down debt concept is that this is something you owe and it's accumulating at an interest rate that might be above what you are making in your investment accounts. However, I just work off of a general philosophy that it's better for me to have my money in my pocket versus for a creditor to have my money in their pocket. And I can, if I was to perpetually keep them at bay, even though I have the money in my pocket, that is of value to me. I don't know if it's a greater value than it is to just pay them off now, but I would rather have you at my door knocking, asking me for the money that's in my pocket because I can tell you no and go spend the money. If the world is ending, I would rather have the money in my pocket than care about the creditor knocking at my door. So, from that philosophical standpoint, I know from a practical standpoint, growing up as an African American in the uh, where I just have to say impoverished community, and growing up in the hood and knowing how we spend money and accumulate money, and our mentality around money, it's the bird in the hand is worth two in the bush. So hold on to what I got right now makes me feel better than about what is about to come. Is what that means, and that's part of our investor psychology, our financial behavior, our financial psychology, investor behavior, and so there's that balance. And so I put the weight towards investing because you're going to see real growth there. But there is a balance. So part of our investing includes paying down the debt, but we do it what I call on the credit continuum. You continue to build your rainy day fund and your investments as you slowly pay down your debt. And when you need to dip into emergency um, use of a credit card, you utilize your rainy day fund for your credit card. You no longer use credit cards in your life. You only spend within your means, and we prepare for rainy days and we invest for the future. So what I mean is, if you're in a circumstance where we have to pay down this debt, this is a circumstance before you met me, because during our financial planning time, if you follow my program, we're not going to even be living off credit cards no more. We're only going to use financing for leverage for business purposes and real estate purposes. So that's the answer. We got to get this monkey off your back, and I say the monkey goes away by you investing more so than by you paying down the credit card. By you investing, you start to see the success. But for the $100 a month that you're investing, 75 goes towards the investments or in fact, to be realistic, it would be 25 towards a credit card. It would be 25 towards a rainy day fund and 50 towards your longer term investments, meaning your stocks, bonds, mutual funds, etc. So anyway, that's the answer on that one. What education courses do you have available? Oh, that was I don't know why I wrote that down. I got a lot available. Primarily, we have a investment club focus. So I have several courses geared towards, economic empowerment is one course. There's there is the investment club creator. There is there's a lot of courses there. There's a money mindset. There's a investment. No, there's a credit continuum, which I was just mentioning. Um, there's Landlord Empire, which is about building your real estate investment company, and this is primarily for anyone who wants to start their real estate investment as a company, but utilized by investment clubs that want to focus on real estate. So they all pitch in, become a a landlord empire. I have Black Money Matters. It's just a deep dive into all aspects of what African Americans need to get their finances in tip top shape, not just in order. I mean, to run the show. And visit our website. Go under investment programs. Bam, so breaking them all down to you, because with all of our courses comes the investment accounts, so that we implement the knowledge that you are learning right then and there. All right, best way to contact me. I didn't know that was on there as a question. Wherever you're seeing this, there's something to click. That's the best way. But sending me an email, I guess, is the best way. But the best way is really book the time. Uh, what you want to talk about. I mean, we can have a strategy session to understand how we're going to work together and what accounts we need to open. But if it's just info you need, the go visit the YouTube channel. Um, but if we need to do some work, you can also open your account without me. You open it, click the buttons, and open the account. There's an account opening button wherever you're watching this. Somehow it leads to there. You go to my website, www.hoodoofinancial.com, and there's absolutely, definitely every means to contact us. Open an account now. Various actions. You can buy our book, get a free ebook, so on and so forth. So that's it. I won't keep you forever. Thanks for listening. I'll talk to you soon.